Bismillahirrahmanirrahim. Assalamu alaikum, students. This is your accounting instructor, Salare. Today, we are going to start the first lecture of O levels accounting, which is known as source documents. Before we start this lecture, I would like to inform you in future, if you want more lectures, please like, share, and subscribe my channel so that you would be able to receive my further lectures too. So let's start with that. Guys, as you already know, that whenever a business performs an activity, that activity is known as transaction. All the business activities are called transactions. It could be sale of product, it could be purchases of product, it could be transactions or activities related to bank, it could be rent paid, it could be insurance of the business. All the activities are basically known as transactions. Now, when we talk about these transactions, remember that these transactions are recorded in the books by the accountant, by the bookkeeper, which are called books of prime entry. So the bookkeeper records all these transactions in the books of prime entry. They are also known as books of original entries as well. These are the very first books in which the transactions are recorded. However, all these transactions, when they are recorded, they need evidences so that through those evidences, the recording can be possible. Without evidences, the bookkeeper does not record the transactions. All those evidences which are required by the accountant or by the bookkeeper regarding or related to a transactions are called source documents. So source documents are basically those documents which act as an evidence of the transactions performed by the business. Through these source documents, the very first step of accounting, which is known as recording, is done in books of prime entry. For example, if I give you a few examples, if you go to the grocery shops and you buy some groceries, the shopkeeper or that store gives you an evidence which shows that they have sold some groceries to you, and for you, you have purchased those groceries. So that sort of paper, that sort of slip is basically known as an evidence of that transaction or source document. If you go to the fuel station and get your car fueled, they give you a slip. That is basically an evidence that they have sold you the petrol or a fuel. In the same manner, if you go to the meat shop and buy the meat, after buying it, the shopkeeper will give you a slip, and that slip will be an evidence for you that you have purchased from them and they have sold. So all these evidences which show that any transaction has been done are basically known as source documents. And through these source documents, the first step of accounting, which is recording, is done. So let's start with that. There are different types of evidences, there are different types of source documents which are used in the business. The first one is sales invoice. The first one is sales invoice. Remember, the sales invoice is used for credit sales. It is issued by the supplier to its customer. Now, a sales invoice is basically issued by the supplier when he delivers the product to the customer. but all these sales are on credit term. That means to say that the amount has not been paid on the spot. It will be paid later on. So the sales invoice is basically issued by the supplier to its customer, in which the credit sales are mentioned. Just let me give you the format, or let me show you the format of business documents, which is an invoice. Now, different type of invoices are made by the business, but this invoice is basically in the book, so I'm showing it to you. Here, you could see the invoice number is mentioned. This is the name of the supplier who has sent an invoice. So the supplier, his address, his telephone number will be mentioned here. Then the name of the customer to whom the products are delivered, his name and address would come. On the right hand side, you could see the date of delivering the product. This invoice will have quantity, the description of the product, per unit price, and the amount. For example, 10-meter cotton fabric design, lemon color. Per unit price is 6. If you multiply quantity with the unit, you will get the amount $60. On the other hand, 30-meter brocade fabric, crimson color, per unit price 15. 30 multiplied by 15, the total amount is 450. So the total product which the supplier, the weavers, have delivered to Sue and Sue is 510. Now, in this invoice, the discount is also mentioned, which is basically the trade discount. As you already know, a trade discount is basically a discount which is given at the time of sale and purchase of product. So this discount is given by the weavers to Sue and Sue at the time of purchase. 510 less 20%. The 20% of 510 is 102. So now, after deducting the discount, the amount of purchase is $408. There are other terms that if the customer pays within 31st May or by 31st May 2019, he will be given 2.5% discount as well, which is a cash discount. So a cash discount is given at the time of payment, right? So this is basically a format of invoice which is sent by the supplier to its customer, which only includes the credit sales. The next is purchase invoices. Purchase invoice is the same invoice which has been issued by the supplier to its customer. See, if I sell you a product, I am the supplier. So for me, because I am issuing that document to you, so for me, it will be the sales invoice. But when you receive that document, it will be a purchase invoice to you. So if you look at here, in the format, it is only written invoice. Sales or purchase invoices are not written. Invoice is written. That means for the supplier, it will be a sales invoice, and the same document will be the purchase invoice for the customer. So purchase invoice is received by the customer, which includes only credit purchases. And the document is same. So I am not going to review this again. You already get to know about this. The next is the receipts. Receipts are basically the acknowledgement of cash receipt. Whatever cash we received from our customer, we give them a document which is known as receipt. It is an acknowledgement that we have received a certain amount from our customer. So it is issued by the supplier to its customer, which is basically an acknowledgement of cash receipt. It can also be used for cash purchases and cash sales. The very common examples are the grocery stores and all your different types of stores which sell you the product on cash basis. When you pay them the cash, they give you a slip. That is basically known as receipt. If you look into the document, there is no certain document which is used for the receipt. Basically, it could be anything. Wherever you go to the grocery shop, you will definitely find that document along with the supplier which is going to provide it to you. Now let's talk about the debit note. What debit note is? As you know, when the customer purchases the product, he receives the purchase invoice. Now, in that particular product, let's say if somebody has purchased 100 units of mobile phones, out of those 100 units, 20 units were faulty. They had some fault in it and they were not for, they cannot be sold further. So those products are to be returned to the supplier. Now remember here, when the customer returns the faulty goods to the supplier, he is going to send a request to the supplier to accept the faulty goods. So that document is known as debit note. A debit note is issued by the customer and it is just a request to accept the faulty goods. That is known as, it is used for purchase return. However, please remember, this debit note is just a request. With the help of this debit note, we cannot record our purchase return. The reason is, we have just sent the request to the supplier to accept the goods. Now it depends on him whether he accepts it or not. If he accepts it, he is going to send another document to the customer, which is known as credit note. So a credit note is issued by the supplier which acknowledges that the faulty goods have been accepted. With the help of this credit note, now the supplier and the customer both are going to record their sales returns and purchase returns respectively. So credit note is used to acknowledge the acceptance of faulty goods, whereas debit note is just a request by the customer to accept the faulty goods. Let's have an example of this format. The format is there. The format is also, there are different types of format, but you could see the debit note here. This debit note is sent by CNCU to the viewers. This is debit note number. It is basically the format from the book. The date of sending the request is mentioned. Quantity 20 meter cotton, 10 meter cotton fabric design, lemon color, has been returned with the unit price of 6, which is $60. Remember that I am just giving you the relation of it. As you already know that the discount was given at the time of purchase. So beta, from this list price, you need to deduct the discount again. So 60 minus 20% is 48. So you are returning the goods of 48. This is basically your debit note or a request to accept the good. The reason can also be written that it's a wrong color supplied. Please issue a credit note. Please issue a credit note means please accept the faulty goods. Now, when the supplier receives this debit note, he is going to issue another note which is known as credit note. So credit note is issued by the supplier to its customer, the date of acceptance, that he has accepted the goods with the particular amount. I hope it is clear to you. Moving ahead is checks. Checks are used for payment through bank. Whenever somebody wants to pay to anyone through bank account, he issues a check to that person. It is issued by the customer or by the payee. Payee means a person who pays. So whoever is paying the amount, he is going to issue a check to this person, and that person can use it as a no as a document from which he can record that he has received the amount. The next is check counterfoil. Now, as you already know, a person issues a check for the payment. For example, if I pays $2,000 to someone, to Mr. A, I'm going to issue him a check. So a check is with him. What sort of evidence do I have that I have paid to him? So beta, along with that check, there is a slip which is attached with the checkbook. That slip is known as check counterfoil. This check is now a document for the receiver that he has received this check, whereas for a supplier, for the person who is paying the check, a document or a paper is or a slip is attached with the checkbook, which is known as check counterfoil, from which we can record that we have paid to someone. If I give you an example of this format, it's all here. There you are. It is taken out from internet, so it might be blurred. This is basically the part of check which has been issued, whereas this is basically the part of slip which is attached. Now this check is torn from here. It is separated from here, and this check is given to the supplier or to someone who we are paying. But this is basically the check counterfoil which remains with us. And from here, we can easily find out who we have paid and how much amount have we paid. So this is known as check counterfoil. I hope it is clear to you. The next is payslip and wage sheet. Guys, the business gives salaries and wages to its employees. To pay them, this is also an activity. So for this, a transaction, the documents are required and evidence is required that we have paid the salaries or wages to our employees. These documents are called pay slips or wage sheets. These are made by the business. Whoever is paying the salaries or wages to the employees, that business is going to prepare this document. It could be a pay slip or it could be wage sheet. Next is bank statement. Bank statement is basically the summary of receipts and payments through bank. A business always has a bank account where it deposits the cash and withdraws the cash. At the end of the month, to check our accounts with the bank, we ask the bank to give us the statement. That statement shows how much amount have we deposited in our bank account and how much amount have we taken out, have we withdrawn from our bank account. And after this all deduction, how much balance is left in our bank account. Remember, this is issued by the bank. It could be issued at the end of the month. It could be issued in 15 days. Whenever the business demands, the bank issues the statement to the business. Mostly, it is on monthly basis. The last but not least is statement of account. Statement of account is basically the summary of account of credit customers. As you know that we sell product to different customers. A huge business or a big business may have many customers and suppliers to whom it has sold goods on credit or it has purchased goods on credit. So there can be plenty, there can be 100, 200, 300. All those people from whom we have purchased goods, we may have had their accounts. In the same manner, to whom we have sold, different customers, they may have had their different accounts. So if for a particular reason, for a certain person, for example, if from Mr. A, I have sold goods and I want him to pay me back for all those products which I have sold him or her on credit, I am going to send him the summary of account. That summary of account will have how much sales have I done with that particular person, how much amount have I received from that person, and now how much amount is left which I am demanding at the end of the month. It is issued by the supplier to demand the amount receivable. Remember, statement of account, you should know two things especially about this. Statement of account is issued at the end of the month. It is basically issued to demand the amount receivable. And remember, it is issued by the supplier to its customer. So these are basically the source documents which are used by the business when he performs the activities on regular basis or on monthly basis. I hope it would be clear to you.